If you lose half your trading account, you need 100% just to get back to where you started. If you lose 80%, you need 400% to recover. Most traders will never make it back from that. But there is a 5-rule system that keeps you out of that hole, even if you're wrong on most of your trades. Here's how it works. Just quickly, this is educational content only, not financial advice. All trading carries significant risk. Now, if you're just starting out in Forex or you've blown accounts already, watch this video until the end before your next trade. I'm Isiah from the Investor Center. Let's start with why managing risk even matters. Here's what most beginners miss. When you lose money, every loss shrinks your base. The same percentage that took it away can't bring it back. Follow the table on screen and you will see how things get progressively harder to come back from as you go down the list. An 80% loss needs a 400% gain to recover. This is known as the drawdown trap. The deeper you fall, the exponentially harder it is to climb back out. It's usually not one big loss that causes it, it's a series of losses over weeks with no risk system in place. In leveraged Forex, those drawdowns can happen fast. This is just one of the 5 rules you need to understand to stay in the game. Everything else keeps you in the top half of that table where recovery is actually possible. And it all starts with this next rule. The rule is simple. Never risk more than 1% of your total account on a single trade. On a $1,000 account, that's a $10 max loss if you're wrong. 20 losses in a row at 1% leaves 80% of your account. You can come back from that. At 5%, you're down to 36%. Things are not looking too good. And at 10%, you're left with only 12% in your account. For most traders, that account is now finished. It's the same strategy, the same streak, but completely different outcomes. The 1% rule keeps losses small, but small losses add up if your trades aren't systematic. But what if you could be wrong more than you're right and still be in profit? With the correct risk to reward ratio, you can be. If you place your stop loss 50 pips below entry, that's your risk. Your take profit is placed 100 pips above, that's your reward. That's now a 1-to-2 ratio. If you take 10 trades risking $100 each, 1% of a 10K account, 6 losses will cost you $600. 4 wins at $200 each will make you $800. You're wrong 60% of the time, but still up $200. A 1-to-2 risk to reward ratio needs about a 33% win rate to break even. Change that ratio to 1-to-1 with the same trades, you're now down $200 instead. Same win rate, $400 difference. Now it's all starting to look like a system. The 1% rule controls your risk amount. The ratio helps keep your wins bigger than your losses, but how do you control risk down to the pip? Before we continue, if you want to find a good broker to put all of this into practice, our top UK Forex brokers breakdown is on screen right now. Anyway, we control risk with our lot size. That's just your desired risk in dollars divided by your stop loss. A $10 risk with 100 pips stop loss equals 10 cents per pip or 0.01 lots. A 50 pip stop with the same $10 risk equals 20 cents per pip or 0.02 lots. Tighter stop, bigger position, same risk. A 200 pip stop needs a 5 cents per pip lot size, but the minimum lot size with most brokers is 0.01 lots. So that trade equals $20 risk or 2% of your account. Position sizing tells you how big the trade will be, but it can also tell you when not to take the trade at all. However, all this depends on one thing, and that's your stop loss. It's your automatic exit where your trade setup is no longer valid, and you set it before entry. Never break this rule. Once it's set, you only move it closer to entry or take profit, never further away. When a trade starts going against you, your brain says, give it some room to breathe. If you listen to those thoughts, everything else breaks down. Your 1% rule is gone because you're risking more. Your position sizing is wrong because it was calculated on your original stop loss. Your risk to reward is ruined because you made risk bigger without making your potential gain bigger. That one decision undoes every other rule immediately. So to recap, here's the complete system. Understand the drawdown trap and where you fit in. Follow the 1% max risk rule. Aim for a minimum of 1-to-2 ratio. Use correct position sizing and never move your stop loss further away from your entry. None of this guarantees profitability and you still need a solid edge. but it will increase the odds of you surviving the market on red days. I hope this video today really did help. And if it did, subscribing to the channel really helps us keep producing these videos. I'll see you in the next one.